Hello and welcome, ladies and gentlemen. My name is Samir Shah, and I'm an M&A partner in Khaitan's corporate M&A group. Welcome once again to this 5th edition of our M&A Academy program. As a part of the M&A Academy, we have consistently been providing foundational legal knowledge and understanding on M&A transactions and processes to corporate executives, in-house legal teams, and M&A ecosystem participants, and all in a corporate style training environment. Our subject today is warranties and indemnities in M&A transactions. As you are aware, in earlier webinars, we have spoken about risk mitigation, and today is really the proof of the pudding, in my view. While you can diligence what you know, a significant risk to mitigate is to diligence or to be aware of what you don't. Similarly, while diligence is a part of buyer beware as a concept, that doesn't take away from the fact that sellers need to stand on their own feet when it comes to providing comfort to the buyer that all is in order, all is well. It is this gap of buyer unawareness and seller comfort that is bridged by providing warranties. In another vein, where the diligence throws up a potential monetary issue, questions arise: how do you give the buyer protection? And that is where indemnities come in play. Both these tools are very useful for us to find a way forward for parties to conclude the deal, achieve their mutual goals, but at the same time, do so very mindful of the risks associated. We hope that by the end of the presentation, we will have communicated to you the finer points of what we as lawyers look to achieve for our clients while negotiating these aspects in any transaction. As always, we do have a presentation, and post the presentation, we will have a Q&A session with audience questions. Please continue to submit your questions on the webinar portal. As always, we will respond offline over email to questions we cannot address due to paucity of time. We will also send the presentation, certain summary notes, and a recording of this webinar to you afterwards. And we will also upload the recording on YouTube. To introduce our speaker today, we have with us my partner Vidushi Gupta, who is a partner based out of our Mumbai office, and she works on M&A projects nationally. With more than a decade of experience, she brings significant deal experience on both strategic M&A and private equity work. While we circulated her profile over email to participants, I would specifically want to talk about her ongoing representation of Axis Bank in its ongoing acquisition of Citibank's 100-year-old consumer and retail banking business. This goes to show that she has advised on multiple high-stakes transactions. So without further ado, I invite Vidushi to deliver her presentation.
Thank you so much, Samir, for that kind introduction, and a very warm welcome to all the attendees. As Samir mentioned, we will be discussing warranties and indemnities today. And these concepts go to the very heart of any M&A transaction. In fact, we corporate lawyers spend a lot of our time negotiating these concepts. And for that very reason, we thought it best to have a focused discussion around these concepts to understand these from both buy side and sell side perspective. So today's agenda is to understand the basic concepts of representations, warranties, and indemnities. We will also discuss the qualifications and limitations that mostly the sell side introduces in the agreements to limit the scope of representations, warranties, and indemnities. We will not keep this session theoretical or boring, and we will try and share our experiences throughout the presentation. Subsequently, we will also touch upon certain credit risk mitigation tools that the buyer side introduces to ensure that the indemnity obligation is actually complied with. Then we will sum it up with key takeaways and open the session for Q&A round. So to start our discussion, let's first understand why are representation and warranties important. It's quite simple. In any M&A transaction or any buy and sell transaction, the seller will know more about the product being sold or the business. And for that very reason, the seller tries to provide comfort to the buyer to ensure or to just comfort the buyer that what he's trying to buy is actually worth buying. So to take a layman example, if we go to buy mangoes, first we will try to spot a good vendor. Then we will try and take closer look at the mangoes. probably we'll even smell the mangoes to make our own assessment of whether those are worth buying. At that point, assuming that our vendor is a good salesperson, most likely she will tell us how good the mangoes are. The mangoes are from the best region possible. And just to make sure that, we are comfortable enough to buy the mangoes. And at times I've even seen that the vendor will come and tell us, don't worry at all, madam, don't worry. If the mangoes are not good, it's at my risk. And this, is a very good example of how representations and warranties actually play a part in any transaction. These are just assertion of facts and used as a risk allocation tool. And these two words, representations and warranties, are mostly bundled together and used interchangeably. However, there is a thin line of difference between the two. Representations are core to the transaction and used to induce one party to enter into the transaction. However, warranties are collateral to the main purpose of the transaction. Another main difference is what is the consequence of breach. In case of misrepresentation, the contract can be held void, and of course, compensation can also be claimed. However, in case of warranties, the contract, in case of breach of warranties, the contract cannot be held void, but compensation can be claimed. When we draft the contracts, we use both these words together to ensure that the concept is covered holistically. And for this very reason, I think I may use the words interchangeably during this session also. Now, coming to the type of warranties, it really depends on which side we are representing. So if we are representing the seller, the warranties can be categorized into three. First one is fundamental warranties. Fundamental warranties go to the very basis of the transaction. So anything to do with authority, capacity, title is fundamental. To take an example, if it is stated that the company is duly incorporated under applicable laws, that is a fundamental warranty. And if we are looking at a share sale transaction, the seller saying that the seller has valid title to the shares, that again is an example of fundamental warranty. The second category is of business warranties. Business warranties go to the type of business we are looking at, and largely the coverage is about accounts or balance sheet of the company. It also refers to the profitability of the company, or contracts, insurance, litigation, regulatory purview. All these are type of business warranties. The third category is of tax warranties. Tax warranties deal with the tax liability of the company, of the business, or of the transaction at hand. Now, if we look at the buy-side warranties, those can be categorized into two. The first one being fundamental, it's the same as we discussed from sell-side perspective. It goes to the basis of the transaction. The second one is of warranty relating to sufficiency of funds. Now, in any M&A transaction, the main obligation of the buyer is to make the payment of the consideration, and that's why it's important for the sell side to have this warranty stating that the buyer actually has available funds to make the payment. Now let's take a practical example. If we go to the next slide, you will see on your screen there is an example of warranty. On your left side, from a buy side perspective, if we see, and if I may just read it out aloud, it states that the company has complied with the provisions of all laws and has not received notice of any non-compliance or inquiry from any government authority. Now, if I am representing the buy side, I will be very happy to look at this warranty because it's really broad-based. But if I am looking at the sell side, I might just say, oh my God, it is so broad-based and almost impossible to give this as a warranty. And what I'll try to do is just limit the scope of this warranty by including certain qualifications, limitations, for example, materiality threshold or knowledge qualifier, or generally limiting the scope of the warranty. If you look at the next slide, here we have enlisted certain qualifications, exceptions, which we normally look at including for warranties. And when we talk about knowledge, if we are looking at a corporate entity providing this warranty, then the key concept is to figure out whose knowledge will really constitute the knowledge of the seller. And mostly what we do is we identify certain individuals or certain designations, the knowledge of who will actually qualify as the knowledge of the corporate entity. And when we talk about materiality, there is a certain higher level of materiality threshold also, which is normally in common parlance known as MAC clause, or material adverse change, material adverse effect. What that is it's just an objective criteria to figure out what would constitute as material event. And it's normally defined as to say that any event which can adversely affect the business of the company or the revenue of the company by more than a certain percentage, say 10%, 15%. And that gives an objective criteria to the materiality threshold. Now, there's certain other qualifications and limitations as well. In the latter part of the warranty, if you see, it says that the company has not received any notice from any governmental authority. Now, this is absolutely a blank statement, and it doesn't have any look back period. So a blanket statement saying that the company has never received any notice is really broad. So what we try to do is limit the time period, and on the right hand side, if you see, we've tried to limit it to 3 years. And if you move to the next slide, there are certain other exceptions also, say giving an exception to say that there are no warranties for forecasts, or there's no warranty provided for valuations, or there's another exception also of ordinary course of business. Ordinary cost is generally defined to say any action which is consistent with the past practice of the company. So that also we generally use as an exception in warranties. Another key concept is of disclosures. And disclosures are something which, as soon as we look at warranties, we start thinking of what should be the disclosure against it. And disclosures go hand in hand with warranties. And these are also exceptions to representations and warranties. There are two types of warranties. One is general warranty and one is specific warranty. Actually, if we think about our first example of buying mangoes, if the vendor tells us that, madam, these mangoes are very sweet, but probably if you wait for 1-2 more days, then it will reach, absolute sweetness. So the vendor is trying to, just disclose that probably right now is not the best time to cut and have the mangoes. So this kind of a disclosure. Now, if you go to the next slide, you'll see that the type of disclosures, like I was telling you, it could be general or specific. So if there is a warranty about litigation which states that the company does not have any pending litigation, then it is again a very, very broad-based statement. And we have normally seen that there are few litigations pending against the company. So then what the company or the seller would do is make a disclosure against that warranty, saying that there are 1, 2, 3 litigations pending against the company, and these are the details of the litigations. So that is a type of specific disclosure which is made against the particular warranty about litigations. Other than that, there are certain general disclosures also. For example, accounts of the company or charter documents of the company, or say data room information or documents. Those are generally provided as exception to all the representation and warranties. So those are type of general disclosures. The next key concept around disclosures is the timing of disclosure, and the timing correlates with the timing of warranties. Warranties are generally provided at the time of signing of the agreement. So at the time of signing, the seller or the warrantor will provide a disclosure letter to the buyer, just listing all the disclosures against the warranties given at the time of signing. Typically, warranties are also repeated at the time of closing. And again, the warrantor will try to give disclosures at the time of closing of the transaction and by issuing an updated disclosure letter. Updated disclosure letter provides updates for the interim period, that is between signing and closing of the transaction. There's normally a time difference between signing and closing, which is used to fulfill any condition precedent, which could be in the form of any regulatory approval which is required for the transaction. And in that time period, if there's any update, that can be disclosed in the updated disclosure letter. So this is the broad concept around disclosure. And again, we spend a lot of time just putting together the disclosure letters. Now moving on to the next topic, which is indemnity. Indemnity, believe me, it's a concept which is negotiated so much that I would say the boardroom would get bored, but the parties keep going on and on and on. And it is actually of significance. It's really important. And why so? That's because, with any transaction comes the commercial risk of it. And it's really important for parties to mitigate that risk. And that's the role that indemnity plays. And that's why, it's fair to say that it does require a lot of negotiation and time. And when we talk about indemnity, there are 4 key concepts. The first one being who's the party which is indemnifying. That's normally termed as indemnifying parties. So if we are looking at a share sale transaction, then typically the sellers will provide the indemnity. However, if we are looking at a subscription agreement, then mostly the company and the promoters or the majority shareholders provide indemnity. So, and if there is more than one indemnifying party, then the concept of joint and several also becomes important. So in joint and several concept, the idea is that the indemnified party would be able to pick and choose as to against which party they want to make a claim against. And that's why it's good for the buyer to have that joint and several liability on the sellers. However, if we are talking about from the perspective of the indemnifying party, we'll try to limit it and say that the obligation of indemnity is only on a several basis. That means it's limited to the obligations of each party who's indemnifying. The second key concept is of indemnified parties. So if we are representing the sellers, we will try to keep it narrow and we will say only the buyer is the indemnified party. However, if we are representing the buyers, we will try to expand the scope and say that the indemnified party would be the buyer, its affiliates, employees, directors, agents. So we'll try and broaden the scope. The third key concept is of loss. So what is actually indemnity being provided for? And the answer to that is loss. Loss generally is defined elaborately in the agreements. The buyer would try to include all types of losses, may it be damages, liability, fines, penalty, or any costs and expenses, including attorney's fees, would be included in the definition of loss. But if we look at it from sell side perspective, the seller again will try to limit it and say that, while I'm agreeing to indemnify, there'll be certain limitations. So any indirect loss or any consequential loss cannot be claimed. So so under law also there is an exclusion of indirect loss or remote loss. However, it really depends on the fact situation as to what would qualify as indirect loss, what would qualify as remote or consequential loss. So it all depends on how tight the drafting is to ensure that the loss concept is also properly covered in the agreements. The fourth key concept is of indemnity events, which is the trigger event. Typically, we have seen the trigger event is loss arising in relation to breach of representations and warranties, or breach of covenants, fraud, and specific indemnity. Just to touch upon a little bit on the concept of specific indemnity. It is specific event which the buyer knows as a possible risk. Mostly when we conduct hours and hours, actually days and months of diligence, we do figure out certain issues or non-compliance. So for example, if there's any non-compliance or there is a tax notice issued against the company which also mentions some penalty amount, then the parties know that there is a possibility of that fine being imposed. So that kind of event can be called out as a specific indemnity event, and the idea is to give good coverage, good indemnity coverage if such loss actually is incurred by the buyer. Now, if I'm for the buy side, I will be very happy if I have covered these 4 key concepts of indemnity. However, if I'm from the sell side perspective, I would just say that this is only work half done, because while the sellers are agreeable to provide indemnity, the indemnity cannot be limitless. There has to be limit to indemnity. And for that very reason, limitation of liability becomes really important for the seller. The different kinds of limitations, the key ones being monetary limits, time limits, and certain other exclusions and qualifications. If we talk about monetary limit, there are 3 concepts. The first one is de minimis. De minimis is a threshold which is specified by the seller or the indemnifying party, suggesting that the loss which is incurred has to be substantial for an indemnity claim being made, and the indemnified parties cannot make claim for any trivial or insignificant matter. So a threshold is set. Say for example, if the de minimis threshold is agreed between the parties to be 10 rupees, and if the buyer suffers a loss of 5 rupees, then that doesn't meet the de minimis threshold, and that's why that loss is not eligible for indemnity. However, if in the same example, if the buyer suffers a loss of say 11 rupees, then it meets the de minimis threshold and the loss becomes eligible for indemnity. The second key concept is of basket. Basket, like in normal parlance also we use, it's used to pull things up, fill it up with something. And in technical terms, when we talk about indemnity, it is used to pull together all the losses which meet de minimis threshold. Because the seller would again see that while any particular loss meets the de minimis threshold, I would like to limit the number of claims the indemnified party can make. So the concept, again, with an example I can try and explain, is if say the basket is of 100 rupees and our de minimis threshold was 10 rupees. So if the loss suffered is of 11 rupees, it gets pooled in our basket. But the basket is of 100, so the basket threshold is not met yet, and that's why the indemnity claim cannot be made. However, if subsequently the buyer suffers other losses which meet the de minimis threshold, so for example, if the subsequent losses are of 11 rupees, 75 rupees, 20 rupees, and if that fills our basket of 100 rupees, then the indemnity claim can actually be made against the parties indemnifying. So that's the concept of de minimis and basket. There's another monetary limit of overall cap, which essentially means that indemnity can be claimed, but seller cannot give a limitless indemnity protection. So there will be an overall cap or ceiling. So for example, if 1,000 rupees is agreed between the parties to be the indemnity overall cap, and the buyer suffers a loss of 800 rupees, then it is under our example of 1,000 rupees being the overall cap. So the entire 800 rupees can be claimed under indemnity. However, if unfortunately the buyer suffers a loss of more than the overall cap, in our example, if say 1,200 rupees loss, then the buyer will be able to get indemnity of only till the 1,000 rupees, our overall cap or the ceiling, which is agreed between the parties. So that's the monetary limits. Now, time limits are equally important for the seller, because seller normally would not be okay to provide indemnity for perpetuity, it has to be limited by time. And generally, that's also compartmentalized into different sections. So for fundamental and fraud, typically we see that there's no time limit. And that's because those concepts are core to the transaction and very basis of the transaction, and that's why no time limitation. However, if we talk about specific indemnity events, it really depends on what kind of events we are looking at. And depending on that, parties discuss and agree upon time limitation. Other than that, for business and tax warranties also, we typically see that different time limitations are agreed upon. And that's because there's different risk perception of these warranties, and even statutorily different time periods are provided for that. And that's why different time limits are agreed upon. Other than that, there are certain other limitations, and there are so many limitations in qualification that we can build in, but because of limitation of time, I might not be able to cover all. But some key ones are that there can't be double recovery or double claims. So if for one particular loss, only one claim can be made, and that loss cannot be covered under many or multiple claims. Then duty to mitigate, which means that if loss is suffered, then after that, the indemnified party also has a duty to take steps to ensure that incremental losses are not suffered because of any action attributable to the indemnified parties. So like that, there are certain other limitations and qualifications as well. Now, after all this work also, so many times, the buyers do ask us very pertinent question that very good that you have decently covered the concepts of, say, indemnity or limitation of liability, but how do I ensure that at the time of making the indemnity claim, the party indemnifying has the wherewithal to satisfy the claim? And that's a very pertinent question. To answer that, we normally advise the clients to include certain credit risk mitigation tools, which can be in certain other different shapes and form. Few of these are here. So the first one being tranche structure, where if we are talking about, say, acquisition of a consolidated stake. Again, let's take an example of, say, acquisition of 70% stake. Then we can tranche it out into multiple tranches. For example, if the buyer can first acquire 51% stake, and the remaining can be bought out subsequently. How that helps is when first tranche is fulfilled, there is still consideration to be paid. So if any indemnity claim comes up after the first tranche, that indemnity claim can be adjusted against the consideration for the subsequent tranches. So that's how tranche structure is one of the credit risk mitigation tools, and to ensure that there is actually money kept which can be used to make good the indemnity loss, the loss suffered. The second concept is of deferred consideration. Deferred consideration is somewhat similar to tranche structure because we do tranche out something, but in this case, the stake is bought in one go, and only the consideration or part of the consideration is held back. Again, the way this structure is used is in a similar way as tranche structure, because certain consideration is being held back, and if any indemnity claim arises, then that can be adjusted against a part of deferred consideration. Third type of structure is escrow. So in escrow structure, the held back amount in our deferred consideration structure, that is put in an escrow account. Why we propose this is sometimes the seller would say that if the entire consideration is not paid, how do I ensure that that the buyer actually pays that consideration later, or the consideration is there available? So for that reason, what we advise is, don't worry, we know that the consideration amount is there readily available with the buyer, and to satisfy you more, we can even keep that amount in an escrow account, which will be opened with a neutral party. So once that amount is kept in escrow, again, if any indemnity claim arises, that can be adjusted against that escrow amount, and the remaining amount can be released to the seller. The fourth concept is of warranties and indemnity insurance. This is a very emerging topic right now, and it's generally being used commonly now. This structure is used to ensure that the indemnity liability of the seller is reduced. And the idea is that if indemnity claim arises, then the buyer can go against the insurance company rather than going behind the seller first. There are different types of policies and products in market today. There could be a buy side policy, there could be sell side policy. Then there are certain exceptions also to this policy products, and there are certain other nuances. And we have in fact done a focused webinar on this topic. Even on the screen, you would see we have provided a link to that webinar. So I would suggest that you go through that webinar also to understand this WNI insurance fully. So this gets us to the end of the presentation today. To sum it up, we discussed how warranties provide assurance on the status of a party's affair, and indemnities provide protection from losses. And both these concepts together of warranties and indemnities are used as risk allocation and risk mitigation methods. For buyers, it is very important to have robust warranties and adequate indemnity protection. And when we look at it from sell side perspective, it is equally important, if not more, to ensure that warranties are qualified and they are not broad-based. Then indemnity obligations are also limited, and we have all these types of limitations we discussed: time limitation, monetary limitations, other qualifications and exceptions. And disclosures also play a very key part in making sure that the indemnity package is good. And while negotiating all these concepts, we corporate lawyers play a very key role of balancing out the interests of both the parties and getting the M&A deal done most effectively and efficiently. So that's all for today's presentation. I hope you found the presentation helpful, and thank you so much for your patient hearing. Over to you, Samir.
Thank you very much, Vidushi. And one can't stress enough, it's such a vast topic. For you to have covered it in such a efficient and short time frame is great. So with that, the chat box has been buzzing, and I've been trying to keep track of some of the questions. Like I said, we also got a lot of questions in registration. So why don't we deep dive straight into some of the questions that came in? So there's one very basic one that at least 3-4 different people have asked. I'm going to try and bundle it together. So it's essentially, you spoke about fundamental warranties, other warranties, business warranties. So what's the mix? Is there a standard mantra? Will every transaction have all kinds of warranties, or how do you typically see it?
Thank you so much for the question. So it really depends on the type of transaction we see, and all the warranties are normally customized to fit the transaction at hand. Having said that, fundamental warranties are seen in mostly all the transactions. And the other types of warranties, say business warranties, tax warranties, it really depends on how the negotiation goes in the transaction, or what kind of transaction we are looking at. For example, if we are looking at a listed company deal, a minority stake sale of a listed company, then we've also seen that there are no business warranties because the type of transaction. And again, if we look at, say, asset purchase agreement or a business transfer agreement, the type of warranties may be slightly different. But yes, we mostly see fundamental warranties, and business warranties also to an extent we do see, but we always customize it to suit the transaction.
Great. And there's a question that I've seen on as is where is basis. So what is this concept of an as is where is basis transaction, and how commonly do you see it?
Yes. So as is where is basis is where actually no warranties are being provided. So seller is basically just telling the buyer that I am selling my business on a as it is currently. I'm not giving you any warranty. You look at it, and if you are comfortable, you take it. Otherwise, you don't take it. So that's the concept of as is where is. It's not that common, and in fact, in most of the transactions, the buyer would want certain warranties. So it's not common, but In insolvency type situations, we have seen as is whereas basis concept being used.
Understood. And you broke warranties into different buckets. Is there a functional relevance to this? I think you answered this question in the presentation, but still, why not?
That's right. That's right. So why we do that is it provides us some ease of drafting. So like we discussed all the limitations, there are different limitations applicable to different types of warranties, normally, typically speaking. So for fundamental warranties, there's no limitation. So that's why we club all the types of all the fundamental warranties together and call it as fundamental warranties. And then we can just state one liner in our agreement that there are no limitations against fundamental warranties. Or we will bundle all the business warranties together and call it business warranty, so that, you know, if we have to specify one particular type of limitation, say time limitation, then we'll just state the sentence and specify business warranties as a concept instead of saying that paragraph 1, 2, 3, 4 of the warranty section. And that's why we typically you know, bundle it together and categorize into different categories.
Understood. So maybe let's jump from warranties to disclosure, and particularly on updated disclosure, there's a very specific question. How often do you see walkaway provisions on the basis of updated disclosure letters? And also, do you see break fees for this reason? Is that prevalent?
Very, very interesting question, and I'm glad someone asked this, because, you know, it's also an interesting discussion which we normally see, because if there is, see warranties are given, and there is the same warranties are getting repeated at the time of closing also, and assuming that there is a big gap between signing and closing, and something material happens in that period, then what happens? What will the parties do? So seller would want to make the disclosure, because of course the seller wouldn't want to make a misrepresentation, so disclosure becomes important. But the buyer might not be okay to have that disclosure, because that can't be an exception to the warranties and limitation to the liability to that effect. But here, you know, two important concepts are play deep role here. So first is, what would be material? So normally we have seen that when parties discuss also, they try to keep it objective. For example, saying that if any event happens which has an adverse effect on the revenue of the company, and it adversely affects revenue by a particular percentage, then that would qualify as material. And if something that material happens, then parties also discuss as to what can be the consequence of that. So one consequence is, like you were saying, walk away right, because if something so drastic has happened, it really affects the business or the transaction, then probably the buyer would want to walk away and not do the deal. However, there's another you know, alternative also. So if there is a risk appetite of the buyer, then the buyer might also suggest that, you know, I will take a call at that point of time, and I might proceed to closing. I will not walk away, I will proceed to closing, but along with certain, you know, mitigation tools, that could be valuation adjustment. So we may have to amend the agreements and mention that the consideration has come down because of whatever reason. So valuation adjustment is one option. Second option is calling that event out as a specific indemnity, so that proper indemnity coverage is there. And I think the second question related one was break fee concept. So break fee is when the transaction does not happen because the parties have spent a lot of time into the deal, say diligence, and again negotiating, discussing the transactions. A lot of time and effort has gone into it. So certain fee will be provided for that. That is generally break fee concept. But in India, it is not so prevalent. I would say in Western jurisdiction, it is used more, but in India it is not that prevalent, I would
say. Great. Just then jumping over from disclosures to indemnities, and there's a fairly fundamental question, very interesting. Can you claim an indemnity for an anticipated loss, or should the loss have occurred?
Yes. So in fact, you know, when we draft the agreements also, or the definition of loss, we specifically call out the word actual loss, the loss incurred, loss suffered. So anticipated loss generally cannot be claimed. The loss has to be suffered or incurred by the party. It has to be actual loss. Then only it can be claimed. And normally we also say that, there's a specific qualification which talks about contingent liability. And that also we sometimes call out because we want to make sure that everything is covered in the agreement. So we do say that, if any contingent loss is there, then unless and until that is actually fructified, there should not be any indemnity claim. So we try to include that as well.
There's a lot of mathematical questions on de minimis and basket. And let me try and get my head around it. But before that, that's a very interesting one. And I'd love for this if I was representing the seller, but let's see how often we get it. Can we do away with de minimis and basket and link indemnities only to material adverse effect?
So see, when we discuss and negotiate, okay, we try to keep it objective to the extent possible. So if we just say material adverse effect, I mean, that's a possibility. I'm not saying that it's ruled out, because obviously it is up to the commercial intention or the understanding of the parties. We can draft whatever the parties want us to draft. So it is possible, but I would say that not having de minimis basket, really then we lose out on objectivity. So it becomes really difficult. But in material adverse effect also, we will of course try and keep certain percentages. The example I was giving, the adverse effect on revenue of the company, but that really goes to an extreme, I would say, and it's preferable to have de minimis basket thresholds.
Understood. Okay, so now just moving into de minimis. So bear with me. So considering your example of a de minimis of rupees 10, if
Right.
my claim is rupees 8, would it be considered under the basket even though it doesn't fulfill the de minimis threshold, or would it be completely ruled out?
So it will not be considered, it will be ruled out, because the idea is that in your example, the 8 rupee loss is very insignificant. And the basis of using de minimis threshold is to outrightly rule such types of losses. Because 8 rupees then in the scheme of things would be considered very insignificant. So it will not be pulled in the basket.
Understood. And just on the basket itself, there's a question saying, interesting, will the basket only be for similar kinds of claims, or can different kinds of claims also be clubbed? So long as they meet the minimum.
No, that kind of limitation is mostly not there. No, there's no requirement of the losses being of similar type. It can be any type of loss. Obviously, it has to be covered in our indemnity scheme or indemnity package. If the indemnity trigger is there, it is meeting the de minimis, then all those kinds of losses can be pulled together.
Now, just on specific indemnities, if we try and read both of them together, can you explain the basic thumb rule as to how do you decide as to which risk qualifies for a specific indemnity and which risk qualifies for a warranty? So how do you distinguish between the two when mitigating risk?
So warranty is more generic in nature, I would say. So in our examples also, just specifying that the company does not have any litigation, that is a warranty. It's a more generic statement. Specific indemnity has to be very specific, and parties are very particular as to what can be called out as specific indemnity, because the concept is that parties know that this kind of risk may come up. And in our diligence also, we actually most of the times we figure out quite a few non-compliance or possible risks, but we are typically not able to put all of those events as specific indemnity events, because the liability really increases in specific indemnity. So it has to be really specific, it has to be material and significant, and the possibility of it actually occurring should be high. It is subjective. What I'm saying is subjective, but it actually depends on the commercial understanding of the parties and how they view that particular event. But definitely it has to be really specific.
Okay. Now, there are a few questions around cross-border indemnities, and maybe just to try and club a few of them. If there's an indemnity payment cross-border, what do you need any RBI approval or anything else of the sort?
So interesting question, and thank you so much for asking, because I was thinking of including it in the presentation, but I could not because of paucity of time. So when we talk about cross-border indemnity payment, it's a gray area, I would say. It's not black and white. So under foreign exchange laws in India, the transactions are categorized into capital account transaction and current account transaction. And so there are certain examples of what would qualify as capital account, what would qualify as current account. And general principle is that if something is capital account transaction, then that is prohibited unless it is specifically permitted. However, when we talk about current account transaction, it is generally permitted, no problem, unless there is a specific prohibition. So that's the key difference between the two. Under foreign exchange laws, indemnity payment is not specifically called out as a current account transaction or capital account transaction. So it depends on the circumstances when the indemnity claim is actually made, whether it will fit into a capital account transaction bucket or a current account transaction. And depending on that, there is a possibility that RBI approval may be required. And in fact, when we are drafting the agreements, we do put in a covenant saying that in case any approval, regulatory approval is required, the indemnifying party shall obtain the approval timely. So just to cover the concept, we do put in this clause as well.
Okay. So in the same breath, we spoke of credit risk mitigation, holdbacks, escrows, etc. Anything specific to bear in mind when dealing with a cross-border transaction?
Yes, in fact there is. Again, so under foreign exchange laws, it's specifically provided that if we are looking at transfer of shares from a resident to non-resident, that means the payment has to be made by the non-resident, then it's specifically provided that for escrow or deferred consideration, there will be limitation that only up to 25% of the consideration can be deferred or kept in escrow. And there's a time limitation also of 18 months from the date of the agreement. So these provisions are specifically specified under foreign exchange law.
Okay. Right. Now, just I guess it's less to do with the concept and more to do with the person involved. There seem to be a few different questions from the financial sponsor community. And again, it's something we deal with a lot. One question was, how does the behavior of financial sponsors differ from strategics with reference to indemnities? There's another question on how does the behavior of sellers who are private equities differ when it comes to business warranties? So do you generally just want to frame that thought, maybe warranties first, so how a private equity would look at giving business warranties very differently?
Sure. And they do come up in in many transactions, because we do look at M&A or private equity transactions. So when we talk about pure financial investors, they are financial investors by the very nomenclature. So they do not typically want to give any business warranties, because the idea is that we provided finances, but we are not looking after day-to-day operations of the company or the business. So typically they don't want to give business warranties. In that case, mostly the warranties come from the company, generally speaking. So the company would provide warranties, and it can be backed by indemnity from the private equity players. But again, indemnity, again, there is some hesitation, because they are private equity funds. So we have also seen lots of escrow arrangements when we talk about financial sponsors. We've also seen a WNI insurance products being used. So yes, I would just say that financial investors normally do not prefer to provide warranties and indemnities. But yes, I mean, it again depends on the negotiation capacity and how the discussions are going on between the parties.
Understood. So maybe now let's move from a financial sponsor seller or a financial sponsor counterparty to an individual. So I can see there's one question which is sell-side-ish, one question which is buy-side-ish, saying if an individual has to give warranties and indemnities, is it reasonable for them to request that their personal assets not be touched? I don't know what personal assets means, but how would you react if you're representing the buyer? How would you react to that? Please exclude my personal assets.
No, that's a very pertinent question. In fact, Samir, if I and you and I are the sellers in our individual capacity, then we would really want to say I have a flat or I have whatever one particular property. I would try and make sure that that is out of this transaction. So that often comes up when we are representing promoters or any other individuals, and it's a common discussion. So we do exclude also personal assets, but if we look at it from buy side perspective, it becomes little difficult, because if say you have lots of personal asset and you want to exclude all of that, then how does the buyer get the satisfaction that you'll have wherewithal apart from your personal assets to satisfy the claim? So it does become important and key discussion topic. So mostly what we do is we include certain covenants saying that personal assets are out of it, but you have to ensure that you otherwise have enough assets to meet the indemnity claim. So yes, there's a lot of discussion around it, and it's a very sensitive topic also, because when you talk about personal asset, it is sensitive, and it goes back to the family discussion, and becomes sensitive at times.
Okay, just a minute. So let's say you as the seller have agreed to give a specific indemnity on a specific diligence issue. Do you also need to specify that in the disclosure letter, or is that some sort of a deemed disclosure?
So that is not disclosed in the disclosure letter. The concept of disclosure letter is you are disclosing something to make it an exception to your warranties, and to that extent, indemnity also gets limited. Now, when the parties have agreed that something is very specific, it is specifically called out as a specific indemnity item, then there won't be any qualification against that, and the disclosure will not work against it, because you can't qualify it. You are specifically calling it out as an event which will be indemnified. So no disclosure against specific indemnity items.
And now, just going back to the PE concept, I have a follow-on question from somebody.
Sure.
It's if a seller is a private equity and they are using a special purpose vehicle, how do you ensure that the special purpose vehicle seller has substance to meet future indemnity obligations?
Right. Again, that's a very, very pertinent question, because mostly how private equity players invest is through special purpose vehicles, which are specific entities used for that particular transaction, or maybe some few other transactions. So a specific special purpose vehicle is used. So and that vehicle might not have any other business. So possibly that the assets are limited, or the income is limited. So in that case, what we normally do is we do put in a covenant saying that the SPV should have adequate funds to meet the indemnity claim. We've also seen comfort letters being provided by the parent or the fund to ensure that if any indemnity claim arises and the SPV does not have assets, then it will be backed up by the parent. So that also we have seen. It's not typical for a private equity player, but yes, we have seen it.
Understood. And maybe one option is insurance. Insurance is something which helps take care of the issue.
Absolutely. And that's why, Samir, I'm glad you mentioned, because that's why this warranty and indemnity insurance product is really gaining significance. It's evolving. And in most of the transactions, parties do ask us, while there is limitation, and just to touch upon a few, there is exclusion saying if there is any known risk, if there's any disclosure, if a disclosure being made, all these are excluded from the product. So there are certain exceptions, limitations. Because of that, I've seen that sometimes it doesn't really work out, the warranty and indemnity insurance, and there's some, it does take some time also, because the insurance company itself undertakes diligence. So there is time also involved in that. So maybe, sometimes parties don't feel that that product can be used for the particular transaction. But having said that, in most of the transactions, I've seen that nowadays party do inquire about WNI insurance packages.
Great. So just before we wind up and I take the last question, there are a few questions on the tax treatment of indemnities. We'll address some of that in subsequent webinars. And there's a lot of Q&A around market standards. I think that's a conversation for a more bespoke scenario. But having said that, we'll address that separately. One last question to you, Vidushi, then is just on, are indemnities the only remedy for representations and warranties, or at least legally are there any other remedies?
So there's another remedy of termination of the agreement. Like we spoke about earlier, also there's a walkaway right. If there's something, there is some misrepresentation, then if it is prior to closing, then termination is one option. And if it is after closing, say theoretically, there is an option of reversing the transaction. But I would say it is theoretical, and that too, it will be limited only if the representation could not be figured out as being misrepresentation through diligence and all. So there is a limitation, but theoretically speaking, there's a possibility of reversing the transaction. Practically speaking, if it can be worked out or not, I'm not sure. But yes, if you ask me legally, yes, there is a possibility.
Okay, there suddenly have come up 3-4 different questions, but let's just address that. This is on diligence and disclosure. No, so there are quite a few I've left aside. We'll have to cover those separately. But last question: would all of the diligence already be treated as disclosed to a buyer? What about information in public domain, etc.? There are 3-4 different questions around this.
Okay, sure. So not really. We discussed the concept of general disclosures. So in general disclosures, we do see disclosure of all information in public domain, say information or documents on a Ministry of Corporate Affairs website. So if the parties agree that those can be disclosed, then those are disclosed in the transaction. However, generally, we don't see such broad-based disclosure. Also, since someone has asked this question, there's a concept of sandbagging and anti-sandbagging clauses also. In sandbagging, the buyer tries to state specifically that the warranties will not be qualified by my knowledge, which may be out of diligence exercise or otherwise. And on the other side, seller tries to put in anti-sandbagging clauses saying that if the buyer has knows of any risk or any qualification to the warranty or has knowledge through diligence or any other way, then that would qualify the warranties. So there are these concepts also. It really depends on what the parties commercially negotiate and include in the agreement. But generally, all types of information in public domain is not a disclosed item, typically speaking.
Great. I think with that, we are nearing time. So what we will do is, before we conclude, firstly, thank you, Vidushi, for taking all of those questions, and thank you to our audience for such enthusiastic participation.
Absolutely, Sameer. I was wondering whether people will ask questions or be shy and not come up with anything. But I'm so glad that we could make it more interactive and have so many questions. Thank you so much to all of you, and especially to you, Sameer. Thanks a lot.
So before we conclude, we have a quick poll which will now be on your screens. We request all of you to please participate, and subsequently we will separately send you a feedback form. It takes less than a minute, but all of your feedback provides us invaluable insight, and we look to mold our future activities and future presentations and webinars on that basis. Great. So thank you to everyone who participated in the poll. And to summarize some of the key takeaways from today's webinar, representations and warranties, while they are not a substitute for due diligence, they definitely help bridge information gaps, if any. And it's important to have a clear set of priorities while structuring your indemnity package. Do you need more time? Do you need more amounts? Do you need more credit risk cover? Just think about all of this from a very cohesive perspective. And having identified a risk in diligence, please rely on experienced and sound judgment around how to tackle the risk, and in fact convert that into an opportunity to do the deal more efficiently. And this is really where quality and experienced advisors will come handy. So with this, thank you to everybody, and thank you to Vidushi for such a concise presentation on an otherwise overwhelming topic. And once again, also to our audience for your attention and your overwhelming participation. We
Thank you
hope
so
you
much.
found it interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you. And please do not hesitate to contact us regarding any matters arising out of this webinar. Our contact information is on the slides in front of you. Thank you for your attendance today, and we look forward to being of service again in future webinars.